Have you ever looked at a company's financial report and just felt completely lost? It's like trying to read another language with all those numbers and all that jargon. But what if I told you it's actually way simpler than it looks? Okay, let's break this down.
Seriously, forget about the stock price for a minute. Forget what you read in the headlines. When you want to get the real, unfiltered story of how a company performed over the last year, where do you even look? How do you get the actual facts? Yep, that's it. The single best tool for understanding a business is its income statement. And at the end of the day, that's all it is, a report card. It gives the company a grade on its performance and tells you a crystal clear story about what went right and what went wrong.
So to read this report card, we only need to understand one single, unbelievably simple formula. This is the engine that powers the entire thing. Now, the official definition sounds a little dry, I know. An income statement, sometimes called a profit and loss or P&L statement, just answers one basic question. After everything was said and done, did the company actually make money or did it lose money? It all comes down to some very simple math.
Let's use a real example. Ambuja Cement. First, you look at all the money that came in the door, the money in pile. That's their total income from sales. For Ambuja, that was a massive 18,777 crore rupees. But of course, you have to spend money to make money, right?
And that brings us to the money out pile. This is everything they had to spend on materials, on salaries, the whole shebang. For Ambuja, that was 15,648 crore rupees. So, what happens when you put these two numbers together?
You get the core formula. It's this simple. You just take the total money that came in and subtract the total money that went out. That is the fundamental logic behind this entire document.
So for Ambuja Cement, that leaves them with a profit of 3,129 crore rupees. But hang on, this isn't the final number they get to keep. There's just one more little step.
From that profit, the government gets its cut in the form of taxes. Whatever's left over after that is the net profit. That's the real bottom line. That is the final grade on the report card. Simple, right?
Okay, so you found the income statement, but then you see two of them. One's called standalone and the other is consolidated. This is a super common point of confusion, but you have to understand the difference. It can completely change how you see a company.
Here's the deal. Standalone is the report card for just the main parent company. But a lot of big companies own smaller ones, right? Those are called subsidiaries. The consolidated report just bundles everyone together, the parent and all its subsidiaries, into one big master report card.
And if you want to see why this matters, just look at Tata Motors. Their standalone report, which is mostly their business in India, shows sales of about 74,000 crore rupees. Okay, but Tata also owns Jaguar Land Rover. When you add that in, the consolidated report shows sales exploding to over 4 lakh crore rupees. You would miss almost the entire story by only looking at the standalone numbers.
This is why you should pretty much always start with the consolidated statement to get the full picture. By comparing the two, you can start to figure out what's really driving the business. Is it the parent company, or is it one of the subsidiaries? It tells you where the company's real engine is.
All right, now that we know which report to look at, let's focus on the very first number you'll usually see, revenue. It's also known as the top line, and the trend in just this one number can tell you a fascinating story.
Take a look at Dixon Technologies. See how those bars are just shooting up like a rocket? In just a couple of years, sales went from around 6,500 crores to nearly 28,000 crores. This is the visual fingerprint of a high-growth company that is expanding like crazy.
Now here's a totally different story, Nestle. The growth is definitely there, but it's a slow, steady, confident climb. It took them about 10 years to double their sales. This is the classic pattern of a mature, stable business, a reliable giant, not a sprinting startup. And finally, this is what a company in trouble can look like. PC Jewelers hit its peak in sales back in 2018, and ever since then, you can see this consistent, painful slide. The top line here is telling a very clear story of a shrinking business facing some serious challenges.
So, revenue is great, but it's only half the story. A company can have huge sales but still be bleeding money if its costs are too high. To really understand a company's fundamental health, we need to go one level deeper.
And that means we need to talk about a key expense called the cost of goods sold, or COGS for short. Think of it like this. If a shoe company sells a pair of shoes, COGS is the cost of the leather, the rubber, the laces, and the wages for the person who actually put that specific pair together. It's the direct cost of making the thing that you sold.
So when you take your revenue and you subtract this direct cost, the COGS, what you're left with is something called gross profit. And this number is incredibly revealing. What makes gross profit so important is that it tells you about the core health of the business. It shows how much money the company makes from its primary job of just making and selling stuff before it pays for all the other things like marketing or office salaries. A high gross profit means the company is really efficient at its core mission.
We can use this to compare competitors side by side. Take these 3 shoe companies in India. Bata and Relaxo both have a gross profit margin around 58%. That means for every 100 rupees of shoes they sell, they have 58 rupees left over after paying for the direct costs. But Campus has a lower margin, at 52%.
And this leads us to the most important part of the whole analysis. Why? I mean, they all sell shoes, so why is there a difference? Is Campus paying more for its raw materials? Is their production less efficient? Or maybe they're selling their shoes at a lower price to try and win more customers?
And that right there is the true power of the income statement. It's not just a sheet of answers, it's a map. It's a guide that helps you start asking smarter, more insightful questions. It transforms you from someone just looking at numbers into an active analyst, ready to uncover the real story hiding in the data.